Hello and welcome to another episode of ET Market Smart Talk. Well, I'm your host, Kshitij Anand, and today we are diving into an important question on every investor's mind. Where should one allocate money in the current environment? Is it the gilt funds or the corporate bond funds? Now, to help us navigate this space, we have with us Mr. Sandeep Ruchira, who is a CEO, Retail Broking and Distribution, and Director at Prabhudas Lilladher Capital. With over 25 years of experience across broking, distribution, wealth, and research, Sandeep brings deep insights into fixed income strategies for both retail and institutional investors. Welcome to the Smart Talk, Sandeep. Great to have you with us today.
Thank you. Thank you for having me on the show, Kshitij. Appreciate it.
Thank you so much for taking the time out. Well, let's just quickly start off between what is happening. There's a lot of volatility, as we discussed, before the show. But between the gilt funds and corporate bond funds, where should investors allocate money in the current environment?
I think, Kshitij, that's becoming a very, very relevant question. With government bond yields having fallen over the past couple of years,
Sure.
people seem to have had a bonanza in terms of returns. However,
Right.
with the RBI moving into what is called a pause on its near-term outlook on rates, yields, and inflation, it's likely that the incremental returns from bond funds may not be as attractive as previously.
Okay. Mhm.
On the other hand, corporate bond funds, especially credit risk funds, have had a good run as well, as the entire
Sure.
yield curve sort of narrowed. We believe that one should have a barbell approach, which means that incrementally speaking, if you were overloaded on corporate bond funds, you should
Right.
reduce exposure because of the risks that we might face. Uh,
Okay.
if you were long duration primarily, you should possibly move to shorter durations with a
Mm.
heavier bend towards short-term bond funds and gilt funds. So roughly, if you asked me, I would be 30% on short-term bond funds, which includes dynamic funds. I would be about 40% on gilt funds, and I would be 30% on corporate bond funds, with about one third of that, roughly 10% of the portfolio in credit risk.
Mhm. Absolutely. And why can fixed income act as both as a hedge and a potential
Yeah,
risk during the volatile market phases?
yeah. No, so I mean, equities and debt typically over the medium term move in opposite directions.
Yeah.
When the underlying economic impulses, like for example, demand slowdown, which possibly we are in right now,
Mm.
as far as India is
Mm.
concerned, you might see yields sort of softening, which means
Right.
if you bought a bond, you would see appreciation in the value of the bond, right?
Okay.
And if economic growth is weakening, you might see weakening in equities because of the earnings impact on the overall market
Mm.
situation. So, to that extent, there's a balance between the two. We always recommend that investors keep about 5 to 10% of their investable surpluses, irrespective of whether you are a very
Mm.
aggressive cowboy or a straightforward person who wants fixed income. Always keep about 5 to 10% of your portfolio in liquid and
Right.
short-term bond instruments so that you
Okay.
have that opportunity to average
Mm. Mm.
between the two asset classes.
Absolutely. In fact, my next question is also slightly linking towards this only. I mean, how can investors use fixed income as a temporary parking strategy before allocating to equities?
I think we're lucky that we're in a situation right now with repo rates around 5.5%.
Sure.
Even risk-free instruments like liquid funds, overnight funds are all
Mm.
yielding between 5.5 to 6.5% kind of returns for an
Right.
investor. So it
Mm.
makes absolute sense, especially if you're a fixed income oriented investor looking at the short term, or you're looking at opportunities in equities, or you're looking at the Trump tariff tantrum sort of playing out over the next
Right.
couple of months. You should definitely be invested into Indian liquid funds and short-term bond instruments for sure. We
Right.
have a lot of uncertainties right now. So if you're a tactical investor, it makes all the more sense for you to be
Mm.
looking very, very seriously at earning this 5.5%, which in my mind is a very attractive return.
Absolutely. And in fact, in the beginning of the conversation, you did talk about the gilt funds. And
Yeah.
is it sort of the time to review and reduce exposure to them at this point in time? How should
If
one
you
proceed?
were, so if you had a higher than 50-60% allocation towards gilt funds tactically, so
Okay.
there are two kinds of investors, right? Somebody with a 5-year plus kind of horizon and somebody with a 3 to 5 year
Exactly.
kind of horizon.
Hmm.
Anybody on the shorter time frame, and by shorter I mean anywhere between 2 to 5 years, you should
Right.
definitely be looking at sort of underweighting gilt funds right now vis-a-vis your exist
Okay.
earlier allocation, because I think we
Hmm.
are past most of the yield softening, right?
Hmm.
Remember that we've had some erratic monsoons in the late part of August, so we don't know what
Right.
in terms of surprises on agriculture inflation might come up. So the RBI may be
Right.
handicapped. In
Yeah.
that situation, long tenor gilt funds may offer certain
Hmm.
risks in the near future, and therefore I would definitely suggest some bit of reduction in gilt fund allocations. Yes.
Absolutely. In fact, the monsoon did stretch towards September as well in many parts
Yeah.
of India, and
Yeah.
that is
And we've had
something
a
that is
bad
a risk
situation
which is
in,
a
yeah, Punjab. I mean,
absolutely
your
right.
agricultural belts have been severely
Hmm.
impacted, so that could have some medium term impact on inflation
Absolutely,
heading.
and that is something which the risk is something needs to be watched out
Yes.
for. Um,
Yes.
on the same side, we talked about gilt funds. So should investors sort of shift their focus towards credit risk funds or corporate bond funds in 2025 for better returns? How should the strategy be?
Yeah, so credit risk funds fall at the other extreme of gilt funds in the risk sense, right? Credit risk sense,
Right.
and we have been overweight on credit risk right from COVID.
Okay.
I think the underlying economic shift that we have seen in terms of policy making and in terms of how corporates approach their balance sheets, there's been a dramatic amount of deleveraging.
Okay.
And what that means is that when you
Mm.
take on credit risk, the
Mm.
probability of a default is much, much lower. I think we're at the
Right.
lowest historical point
Mm.
right from 2006 onwards.
Mm.
So to that extent, you should definitely be invested in corporate bond funds. Now,
Okay.
whether you should be looking at credit risk would also partly depend on your risk profile.
Right.
There's an enormous amount of liquidity now available in what we call the mid-tier and lower rated bonds. These balance sheets are very healthy. I
Okay.
would suggest that if you had a 100 rupee allocation towards non-gilt fund kind of bonds,
Right.
roughly about 33-35% of that could and should go towards credit risk for sure.
Okay. Absolutely. And when we're
By the
talking
way,
about
sorry, Kshitij, let me
yeah,
point out something I read recently. Last
uh,
month was historically the highest month of emerging market uh, junk bond, or what we call high yield bond
high yield.
investments by
Okay.
foreigners, right? So
Uh,
that
uh,
that kind of flow is already there internationally, and if that finds its way into India, right,
mm.
we might have that additional kicker coming in from much lower yields and stressed out uh, bonds at least.
Exactly. Right. And, when we're talking about bonds and interest rates, I think for the benefit of investors, what are the key interest rate risk investors should be aware of when investing in a debt instrument today?
No, I think so. From a risk point of view, I think inflation is the key macro, right? And to that
Exactly.
extent, what happens to the GSEC is the primary. We've had a 20 bips kind of turn in GSEC. We were at, I
Mm.
think, 6.26 a couple of months ago, and we're currently around almost 6.5%. So I think what
Right.
happens to GSEC yields is of primary importance. I think in
Mm.
terms of credit spreads, which means the spread between a triple A rated paper or a double A rated paper in the GSECs, we are at about
Right.
roughly about 80 to 90 bips, which is an equilibrium. So I think what happens to inflation and therefore GSEC yields would be the primary driver of risk for bond
Sure.
investors. Yeah.
Absolutely. And what fixed income allocation strategies would you recommend for institutional investors like corporates or trusts?
These are very differentiated entities. So from a trust
Uh,
point of view, I think GSEC should form a large component because you don't want too much volatility.
exactly.
Therefore,
Right.
about 70-75% of that money should be in GSECs and
Mm.
relatively risk-free instruments. About a 10 to 15% allocation should definitely be towards dynamic bond funds, which means you're giving
Sure.
leeway to the fund manager to decide what to do with the money, and about
Mm.
10% to what I would call high yield bond funds, right?
Sure.
Which come in various shapes and sizes. It could be as simple as a corporate bond fund or as complicated
Mm.
as a credit risk fund.
Okay.
From an institutional point of view, I think the primary objective for an insurance company, for example, would be
Mm.
long term. So I think there are enough 10-year plus kind of tenor funds available, and therefore we would
Right.
recommend longer tenor GSEC funds,
Okay.
including target plans, and of
Mm.
course a large allocation towards corporate bond funds. I don't think credit risk funds should be possibly part of their portfolio, except for a small
Right.
little delta here and there. But otherwise, these are the two categories. They should never be obviously in shorter term instruments.
Absolutely. Well, on that note, thank you so much for your time, Sandeep, for sharing your insights on the evolving fixed income landscape. Your perspective
Thank
on
you so
how
much.
investors can balance gilts, corporate bonds, and other debt instruments in 2025 are extremely valuable. And to our listeners, well, thank you for tuning into this episode of Smart Talk. Stay connected with us for more conversation with market experts, helping you make smart investment decisions. Well, until next time, stay invested and stay informed. Thank you so much for your time.
Thank you.